Welcome back, everybody. We're on to Unit 4 already, and it's really flying. And we're going to talk about finance. And so this lesson has a lot of parts to it and a lot of definitions to it. So if you have not taken the time to print out the slides, please go back and do that now. Put me on hold here, right? And go and print out those slides, because if you don't take your notes on the slides, when you get to the quiz, you're going to be spending hours doing the quiz. And I don't want anybody to do that, especially if you can get it right the first time, as they say in manufacturing spaces. Get it right the first time. So please print those out and take your notes right on them, because it's going to be very beneficial. So when we talk about finance this week, and first off, I'll apologize, I'm a little nasally. I've got a bit of a cold, so please bear with me. I promise not to spread any germs through YouTube. We're going to talk about some of the basic functions of a finance department. These are very, very basic, and everybody's finance department does things a little bit differently. And that's what you need to remember, really, when we talk about all these different types of departments, HR and finance. I did a lot of research into not only the workings of the companies that I've worked for, but also other companies, and ask peers and contacts about, what is your HR department? Are they responsible for safety? Are they responsible for background checks with finance? Do they do expense reporting, or does that go to somebody else? That type of thing. And so we're going to really talk generally. And the whole idea of this course, at least the first half of this course, is for you to understand a little bit more about organizations and how security kind of meshes in that organization. So, bear with me. This is very general stuff. There's going to be a lot of definitions. We're going to talk about your financial responsibilities. We're going to look at some very, very basic budgeting and a simple line item budget format, which may or may not be different from what you see when you get to your workplace, but you'll understand some of the terms. We're going to talk about then, on the security side, some of the risks of the finance function and how security, HR, and now finance can fit in that whole enterprise security risk management model. And one of the things that we're not going to do a lot of is math. And I will tell you, story time here. I have one grade on my transcript from my 8 years of college that haunts me, and that is statistics, because statistics, as you can imagine, is all math. And I am not a mathematician, and so I'm not going to expect you to be. By the way, that grade is an A-, and my wife put me on suicide watch when I got it, because I've never had a minus after an A. So look, we're not going to do math. So if you have math anxiety, now is the time to breathe in and out and take a moment, meditate, because we're not going to really talk a lot about math. There'll be some numbers, but only in examples of formats. So strap in, here we go. We're going to talk about finance. So a finance department, just like an HR department and a security department, has some very basic functions that pretty much go across the board. One of the big ones is they collect receivables. Receivables is money that customers owe you. They buy something from you, and then you pay them. That's a receivable, right? They process payables. They pay the bills. So receivables is money coming in from customers, and payables is money going out to suppliers generally, right? They normally have the procurement or purchasing department under them, and they buy goods and services, otherwise known as indirect. So you'll see the next line says they also procure direct goods. So direct goods are things that actually go in your product. So if you are manufacturing televisions, the black plastic framing that normally goes around the flat TV screen, right, on every one of them's got something either on the back or on the sides, right, and it's black plastic normally. Those would be direct. They're direct, something you're buying that goes directly into your product. Indirects would be the tools to put it together, possibly landscaping services, security services like guard bills and things like that. Those are indirect. You don't need those to make the product. You only need those to support the safe and orderly and other type of operations to make the product. So we have indirect procurement and direct procurement. So look at that. You've learned 4 terms already if you didn't already know them. Receivables, money coming in from customers. Payables, money going out to suppliers. Indirect goods are things that you use in your business that don't directly impact and go into the product. Direct goods are those that you buy that go directly into your finished good. They prepare financial statements, tax documents, projections. Projections are just that. If we spend about $2,000 every month on let's see. Two-way radios, right? We have a big operation. We have two-way radios. We have to have the license. There's maintenance. You have to buy new ones when the old ones get ruined or get lost. We spend an average of about $2,000 a month. We know that in our budget, we're going to ask for about $24,000 a year for two-way radios, right? Because that's our normal spend. But if we see that we've lost a number of radios, a number of them have gotten broken, people are not taking good care of them, and we see in the first 6 months of the year, we've already spent $20,000, our projection is that we only have 4 left, or next year we better put more money in because the radios are starting to go bad on us. So they'll do those projections so that you can help plan. And then they'll ensure Sarbanes-Oxley reporting and other laws are followed. Sarbanes-Oxley is an act of Congress, and it basically says that companies need to keep certain records and be able to produce those records so that everybody's accounting is the same. There was certainly a great deal of misbehavior in the, I would say, the late 1990s when you look at WorldCom and several other companies, Enron, that did not have their books in order, right? Investors and others were not able to look at their reports and say, this is a good company to invest in or a bad one, and both of those ended up being very bad. They both took a lot of investor money and a lot of money out of pensions for their own employees. So the Sarbanes-Oxley, named after 2 senators, requires companies to report things in a very uniformed way so that investors and employees and suppliers and others understand whether the company is going to have the money to pay their bills, to pay their pensions, to pay their investors. So there's a big bunch of functions of a finance department and a big bunch of definitions that you may or may not see on your quiz. So hopefully you've taken those notes. And again, there's very intricate definitions for each one of these terms. I gave you the simplest one that will work in 99% of discussions. So that's the way we're going to keep it through this entire discussion. So how does any of this impact you? Well, it impacts you in a lot of ways. I mean, one of the payables might be travel. And if you're like me, I usually have a travel bill of somewhere between $50,000 and $100,000 per year for plane fares and hotels and entertainment and the like. And that's relatively high, but if you look at the price of a ticket to the Far East, you're going $12,000 to $15,000 for a first class seat. So it adds up, right? Procurement is one of the major players in the security manager's life. You have to buy things. Okay, so procurement, when you go and you say, I want to buy two-way radios, right? We'll stick with the radios for this discussion, and I need 10 of them. And they ask, well, how much do they normally run? And you say, oh, $2,500 a piece. I'm going to need $25,000 worth for these 10 radios. They will go out and they will say, okay, give me the specifications on the radios you need. What must they do? Well, they have to communicate back and forth. They need to have a removable battery that lasts for at least 8 hours. They need to have a little red button on the top that if I push it, it sends a signal to let somebody know that my guard is under duress. He's got a problem. I needed to have at least 4 different channels so that one group can be on one channel and another. You give that whole list of specifications to your procurement person, and they go out and find potential products that can do that. They will give you some suggestions. Here's Motorola, here is Sony, here is Samsung, here is whoever. And once you decide which one you want, then they go out and negotiate the price for you. Procurement is really good at negotiations. That's what they do. And I will tell you that if I had to negotiate some of my own contracts, I would have spent millions and millions of dollars that I didn't need to spend because a very stubborn and great negotiator in procurement was able to bring my prices down. So procurement or purchasing, it's called both, and about 50-50 in companies. They are the arm that is ensuring what you buy is the right price and that contracts that we do are fair and they protect your interests, right? They do the contracting. Now, the projections and reporting, very similar, so we'll use them almost interchangeably. Those will help you plan for those rough roads and cuts that are ahead. So, for instance, if your company produces televisions and we find out that the economy starts to tank and people aren't buying televisions, right? Unemployment may be high, the market may be saturated, the cost of televisions is going down, and people just aren't buying them, right? They just don't need them for a quarter. Right. Some years ago at Christmas time, back in probably the 1980s, maybe 90s, when flat screens first came out, everybody got a flat screen TV for Christmas, right? Now, that's not really a normal Christmas gift. I mean, it can be, but not at the same volume. And if you know that the projections are that something's not going to sell, oftentimes your finance department will come back and say, you need to cut your bills by a little bit. We want to keep our profits steady as much as we can. So the way to do that is to, if we're going to sell less, then we need to spend less to make it. And often indirects like security are asked to trim their bill a little bit. You may need to lay off someone. You may need to defer some maintenance on something. You may need to use less supplies, right? If you have a large property and you have a guard driving around in a vehicle and he uses $1,000 worth of fuel every month, you may say, I want you to walk, or I want you to drive 50% of the time. The rest of the time, I want you to walk around the outside of the facility, up in the windows if it's bad weather, and look out at the property that way, just to trim some costs. Projections help you do that. Again, with the reporting and the projections, that run rate, how much money are we spending versus how much did we budget, is really important to a security manager so that you can keep your spending in line so you have enough money at the end of the year. So, procurement, one of your best friends when it comes to contracting and buying stuff, because they're going to get you the best prices. That's their job, to go out and buy things at the best possible value for the company. The projections and reporting are going to help you understand what you have to spend and keep you online with spending your allowance, if you will, and making it last the whole month. So let's take a quick breather here, because we're going to go into more definitions, right? These definitions are the majority of this lecture, and so hopefully you're not doing this while driving, but take them one at a time, each chunk a little at a time, and write the definitions out and understand them as we go along, and then we'll reinforce those. So the next set is operational expense versus capital expense. And I will tell you that in every class where I discuss this, somebody comes back and says, well, my sister is an accountant and she says you got this wrong. And I didn't really get it wrong after further discussion, but there's a lot more to it than what I'm explaining to you here, okay? So if someone says, well, that's not how I understand it, well, it's, this is the most basic form of OPEX versus CAPEX. Operational expenses are day-to-day things you use to operate your business, okay? There are certain things that you use every day, guards, janitorial services, the power, your telephone bills, all those are operational expenses. They're the normal day-to-day expenses just to keep the place running. Okay? Capital expenses are long-term investments in your business. Big buildings, major equipment, building systems, things that go directly into your manufacturer or of your product, which may be information, right? Some companies, their product is information. It's not something you put in a box and sell. Those can be capitalized. And a smart security manager uses both in their planning, and let me explain why. The real difference between OPEX and CAPEX really is time and tax. I mean, there are other differences and nuances, but from a security manager's perspective, you're not going to be an accountant, right? You're going to be a security manager of one form or another. You just need to understand that OPEX, operational expenses, are paid for immediately. So let's say you are a Uber/Lyft driver and you want to do it right and you want to incorporate, and this is going to be a real business for you. You may even take on more drivers and they give you a cut and you'll provide the car and gas for them or something, right? So that you can build a real business. The operational expenses would be things like gas. You pull up to the gas pump and you put in the gas. The person at the gas station wants to be paid immediately, and you do that, and you have to account then that you put in X number of gallons at X amount per gallon into a ledger, and at tax time that would be an operational expense that perhaps is a write-off, and in many cases it would be. Okay? CapEx might be the vehicles that you're going to buy for this little operation. So let's just say that you decide you're going to buy vehicles that are $30,000 each, and you're going to expand your operation, you're going to buy 4 of them. Well, your operation is small, and you may only be taking in and profiting maybe $50,000 a year doing this, right? Which is not a lot for a small business. But say you're making $50,000, and you're going to buy 4 vehicles at $30,000 each. That's $120,000. You're going to show any future investors that you lost $70,000 that year. If you capitalize this over an amount of time, then you can do it maybe one vehicle, two vehicles at a time. A vehicle lasts a certain amount of time. And even though the person at the dealership expects to be paid, you're going to put it on your books over the life of that asset, right? So if a vehicle, say, will last 10 years, which is not uncommon with today's modern vehicles, and it's $30,000, each year you're going to show on your books $30,000 for vehicle costs. And there's a formula to it where you pay more up front and a little bit less each year, but nonetheless, you will show it that way. So a future investor will look and say, okay, they made $50,000 in that year and they spent $3,000 on vehicles. Well, they really didn't spend $3,000. You really spent $30,000 on that one car. But you're able to put it down in your books a little bit at a time over its useful life. You capitalize that expense. And for tax purposes, a capital expense, something that qualifies as a long-term investment in your business, is taxed differently than the gas that you put in, right? The gas that you put in comes out of your normal funds, and you're paying normal income tax rates on the money you use to buy the gas. Whereas at the end of the year, when you do taxes on your capital expenses, you will pay a much lower tax rate, and you will pay it over time. It's paid through something called depreciation. So the asset will depreciate a little bit each year. It's worth less, and each year you can put down what the asset is worth, right, and onto your books. So I know it's a little bit, I won't get too much into depreciation other than the fact that depreciation will be something that hits your budget. That rather than the $30,000 that you actually spent on the vehicle, your budget will take a $3,000 hit. The corporation itself had to spend $30,000. You're really out the $30,000, but on your books you're able to say $3,000 per year times 10 years. Okay? And that makes your it actually normalizes your business, because when you have a big expense of putting up a building, a family where the husband and wife and two kids, and they have an income of say $100,000 combined per year, buys a house, they don't take that hit. They actually make payments on mortgage on their house, right? If they had to show that they spent $300,000 on a house and they only made $100,000, basically they'd be $200,000 in the hole. They're able to actually make payments. And that's you're kind of making payments to yourself when you're a big business. You don't borrow the money from a bank. You borrow it from yourself and you lay it out as if you made a loan. And you pay less taxes on it that way, and it's less impactful to your financial statements. Now, a capital expenditure can't be forever. It's got to be tied somewhat to the life expectancy of that resource. So to capitalize a car and say, well, I'm only going to take a $300 hit and I'll capitalize this car for 100 years is not logical. Very few cars last 100 years, and if you're using them for Uber and Lyft, you're lucky to get that 10 out of them, and you better have some darn good maintenance, right? The other thing is that when an item is no longer useful, you can write off that remaining amount and just take it off your depreciation. So once it's done, it's done. If it didn't last the 10 years, then you no longer need to pay tax on it because you won't have it, and you can write it off your books as a loss. So from a tax perspective, really is how we're looking at OPEX and CAPEX in your mind, and you're also looking at it from a budget perspective as a security manager. If your budget as a security manager is $100,000 a year, and you have to buy an access control system, a card reader system, right? You've seen them before, you use them in the dorms. If you have to buy one of those, they are more than $100,000. So in essence, in your budget, you could never buy one of those. But if you're allowed to capitalize it over the life of that system, and those systems can be capitalized for 7 to 10 years, depending on what you integrate with them, you're able then to show on your budget you're paying for it over 7 years. And that $100,000 access control system now is a $10,000, $12,000 hit to your budget every year. I think it's 7 years, it would be about 14, 15,000, right? 15,000. Again, we're not doing math here, right? So, but you're able to account for it a little bit out of your budget each year. So then you can spend the remaining amount on the other things you need for operational expenses. If you had to put it all down in 1 year and spend it, you would have no money to operate. You couldn't pay a guard. You couldn't pay for your vehicles. You couldn't pay for the radios that you might need to operate as a security department if you had to spend it all in one shot. So CapEx gives you a way to take items that have a long-term impact on the business, that have I keep saying it, they're capital expenses that are important to the business, expensive, and have a lifetime. They're not one-time things, right? So a light bill doesn't have a lifetime. When you pay the power bill, it doesn't have a lifetime. But if you put in all new lighting fixtures in a factory, because LEDs are cheaper, they're more energy efficient, so they're more environmentally friendly perhaps to get rid of the components. I mean, there's a whole lot of things. You could capitalize changing out your light fixtures if you had spent enough money on it, but it's smart for you to do that. But you still have to pay the light bill in OPEX. So I hope that explained CAPEX and OPEX somewhat to you. Again, this is a real basic definition, and it varies, and accountants will say, no, there's this tax implication, and there's this way you have to depreciate, and there's declining amounts in your depreciation amount. We're doing a straight depreciation over a certain amount of time because that's what a security manager normally thinks about. So when you buy things that you need day to day, your guards, your fuel, your, maybe even your vehicles, okay, you use OPEX for that. When you buy big things like big camera systems and electronics and the things you need over time, you capitalize those. They come out of your budget in chunks each year, and then you still have money left over to spend on those OPEX things. So that's the definitions of OPEX and CAPEX. Until you have lots of time in this field, no one's going to expect you to know budgeting and to do budgeting. But I will tell you that it is one of the most anxiety-producing things when you get into your first big job, right? And you get there and they say, okay, I need you to work on the budget. Can't tell you how many people just melt down in tears because they have no exposure. So this is all about exposure, this first part of this lesson. So again, relax, take a breather. No one's going to expect you to know all this stuff when you get to your first workplace. But the more you know about it, some exposure to it, hearing it and hearing the terms not for the first time will lessen your anxiety, and that's a good thing. So a simple line item budget is just that. It has a line for what you're going to spend the money on and a line for the amount that you expect to spend on that item. So again, go back to those radios. If we had two-way radios and we expected to spend $24,000 a year to maintain and pay for the licenses, FCC licenses, things like that for two-way radios, then we would have two-way radios as a line item, $24,000 as our amount. And each one of those lines comes down to the bottom and it adds up to what your budget should be. There are two methods to preparing a budget, zero-based and cost-based. Cost-based basically takes what you spent last year and then makes an adjustment for it. So I look at last year and I spent $24,000 on maintaining the radios. Well, one of the things I spent on were brand new batteries for all of them. The batteries have a life expectancy of 3 years. In my cost-based budget, I would then not say, well, maybe I can spend a little less on my radios because I don't have to buy all those batteries because remember we just replaced them. Or maybe we replaced a lot of the radios and we did them ones and twos. We didn't capitalize it, right? We just replaced ones and twos, but those should be good. So I should spend less this year. I can knock that down a little bit. Or I know that the batteries are starting to fail. I don't have to replace the radios, but the batteries are starting to fail. And we haven't replaced them in the last couple of years. We better put a little extra in that. That's what cost-based is. You're taking your experience from what you have spent before and adding and subtracting a little bit from it based on what you expect your cost to do in the next year when you prepare your budget. Now, zero-based is just taking that line item and putting, I need two-way radios. What do two-way radios cost? And what would I expect to spend on those? You're not taking any of the history into account, right? You do this sometimes with new things that you add to your budget. You've decided that you had a security program. It was a small one. You didn't have any guards. It was just you, right? It was a small facility. It was just you. You didn't have any security guards. But somebody said, hey, I think we're going to use a security guard in the lobby to welcome our visitors and to screen them to make sure that we're not letting bad people in the building. You need to add a guard. That would be a zero-based item. It's a new item. And you can do your budget. And I suggest that every 4 or 5 years you zero out everything in your budget and build from zero to see if your numbers haven't fluxed so much with your history that maybe it's time to go out to bid. Maybe it's time to rethink whether or not you need certain things. A good item to think about this is your cost of vehicle repair. So if last year you spent $3,000 on vehicle repair for one vehicle, right, which is normal. I mean, maintenance and, when guards drive security vehicles, they drive them like they stole them. Okay, so they get beat up. Okay, so you spent $3,000 last year. And then you go in and you say, The vehicle's getting a little older. I need to spend maybe $4,500 next year. So you budget for $4,500. Well, that same vehicle happens to be on the road. The next year you go in and you say, well, I better up it a little bit because, it's got 100,000 plus miles on it and they're driving it 24/7. Maybe I'm going to need 7,000 next year to fix that vehicle. Well, if you start at zero and you say, what does it normally take to maintain a vehicle per year? Well, I need gas and oil changes, and I need maybe, X amount for normal repairs. The muffler goes bad once in a while, and the battery may need to be changed. Normal vehicle, you look it up somewhere in a benchmark somewhere, and somebody says, it costs about $1,500 a year for maintenance on a normal vehicle. So there's your zero base. Now you can compare your zero to what your cost base was, which is the $6,500 because the thing's getting old. You can say, you know what? Maybe it's better for me to put $1,500 in there and buy a new vehicle. So zero-based and cost-based help you rationalize your cost. Most of the budgeting you will do in your lifetime will be cost-based. You'll look at what you spent last year and you'll say, okay, that was reasonable. Prices went up a little bit, so I need to put a little more. Or last year I spent a little more because I did this and this and this, and I don't need to do that every year. You put in maintenance for your guard shacks, and last year you painted them. You don't have to paint them every year, so you take a little bit out. Most of the time you'll look at what you spent last year and you'll build your budget from that. But every once in a while, it's good to zero base them and just make sure that you're not overpaying. Okay, so that's really what it's all about, whether you're taking historical data based on last year's expenses, or whether you're starting from zeros and justifying everything that you want. Okay, and the zero base really helps you in the long run, doing it every once in a while so that you can get it right in your head that you're spending the right amount of money and not overspending based on costs going up every year. So let's take a look at a line item budget, very simple one for a security department that I built just on the fly. And one thing to understand is bottom line spending, and we'll talk about that when I pop it up. I'm not going to talk about it here too much. But every organization has their own methods. Not everybody does it the same way. Some have set forms they want you to use. Some will send you an Excel spreadsheet that you fill in the blanks, and it's a little different. They ask for different items. But this is really what most of your zero-based budgeting will look like, or not zero-based, your line item budgeting will look like when you first do a budget, okay? Again, everybody has their own forms and their own look to it, but this is kind of what they all have in common. And the cost-based research is really the good starting place. If you inherit a budget from somebody, you get there the first time and you replace somebody who retired and they say, well, Bill used to do the budget, so now you got to do it. Look and see what Bill spent last year. That's the best way for you to start with the first time you do a budget. So let's just take a look at what one of these things looks like. I'm betting this is really small on the presentation, but because you printed out not only the slides, but also the addition that I put in with the slides, you have this in front of you and you can see it in an acceptable size. So in this particular case, we looked at what we spend on guards, right? So guard services, we have 336 hours per week, right? I got the formula down here, times 2 guards, 24/7, times 24-hour bill rate. And then you have to add in vacation and any incentive payments if there's, any additional costs, right? So if we have 2 guards 24/7, that's actually 336 hours per week. It's not 80 hours, okay? And we'll go over that when we talk about guard services. 2 guards, if you have 2 guards every shift, you actually have 336 hours of coverage because you're covered around the clock. And if your bill rate is $25 per hour, that's what you're paying the guard company, not what the guard is making. And then you have to add in some vacation and all that sort of stuff. We end up with $450,000 per year for 2 guards around the clock. Okay, that's an OpEx item, right? These are your operational expenses. Contracted guards, $450,000. Okay, I'm going to hire some consultants. They aren't associated to a particular, capital project. These are just consultants like I may need to hire a private investigator to do some things for me. I want to hire somebody to do some training for my guards or for my employees, right? Those types of things, $50,000 OpEx. Integrators, the people who will fix my card reader system, those things, $30,000, right? That's for parts and labor for the stuff I already have in place. A camera goes bad, they have to come in and pop a new camera on. It's going to run you about $1,000 plus another $1,000 to have them install it, program it, all that stuff. Happens several times a year. I looked at last year Bill's budget, and he spent $25,000, and I know that some of the cameras are getting old, so I'm guessing $30,000. A lot of this is, I won't call it guesswork because you're using some data that you have, but you have to also do some projections in your own mind, right? Monitoring fees. I have a alarm service on one of my warehouse buildings on my property that an outside alarm service handles for me, and they charge me a certain amount per month for monitoring and a certain amount a month for rental of the equipment, $5,000 a year. That's what they charge. I know that they charge $5,000 because I have a contract with them, so I can put that $5,000 in and know that's going to be a good number. Awareness materials, things that you might have for, vehicles. Let's go to vehicles. So that's, the guard company's going to drive them around, right? I'm leasing these through my guard company because I want to avoid some liability, and they charge me $15,000 a year for that one vehicle to lease. That sounds very high, since if you think about it, $15,000 would be a car payment of about $1,200, a little more than $1,200 per month. But they're also taking care of the liability insurance. They're taking care of the tires and the repairs, and the only thing I have to pay maybe is fuel. So $15,000 is a pretty good deal for a vehicle for 1 year. So I put that in there. Awareness materials, things that you might want to print up. You might want to have, department coffee cups made. Again, you might want to have a lunch and learn where you bring somebody in. Awareness materials, it's always something you want to put in your budget. Communication equipment, radios, repairs and maintenance. That's just general repairs and maintenance that you might need to do to, every year if you have a guardhouse and you have a bollard, the stand that goes out in front of a guardhouse so that the guard doesn't get hit, the one made out of concrete, that big pole. Somebody will hit that pole. You'll have to have somebody come and paint it. You're going to need to buy the paint and the paintbrushes or hire somebody to do it. In the course of a year, you're going to need some money for repairs and maintenance. Put in a number, right? Salaries. Security manager themselves goes with the next department, but I've got a couple of supervisors here at $85,000 apiece, or $85,000 and $75,000, and then I have a bonus target. And then I also have to account for their benefits, right, which is usually about 30% of salary. You don't need to remember any of this. We're just looking at how this is built, right? You're building in individual lines and putting in an amount based on what you know and what you project, what you think it's going to cost you. And then you get to the depreciation line. So we'll come back to that line when we do the CapEx down here. But basically what the depreciation line is, in the last couple of years, you have bought some things. Where are we? Right here. Communications equipment, the radios, the card reader system, right? Where you have the repairs and maintenance and the integrators, right? You've got a card reader and a camera system in your facility. You bought all those and you bought them over time, right? They're depreciating. In this case, for the $60,000, I may have paid $420,000 and I'm depreciating even straight line depreciation over 7 years. So I'm putting $60,000 in to pay back that money. Now the company's already shelled that money out, but look at my total budget here. I mean, look, I'm at $942,000. If I had 1 year where I had to spend $460,000, I wouldn't be able to pay my people, right? I wouldn't have enough money left over for salaries, benefits, and the guard services for sure. Just there, I've got $500,000 plus. And if I had to spend $500,000 pretty much to buy my card reader and camera system, I'd be over budget and wouldn't be able to make any of the rest of these payments necessarily. So I'm able to spread it out over time and make my budget livable, okay? So I put my depreciation in here. So my total budget here for OpEx is $856,800. I have a contingency. In a line item budget, you always put a contingency. We call this the stuff happens line, right? Incidentals. If you put in 10% for contingency, someone may come back and say you need to cut your budget a little bit. Your budget was too high this year. That's where you can kind of start and say, okay, well, I just need to watch for, I need to be careful with my money so that if something comes up, I've got enough up here to cover it. But what you're actually spending is this money. So when we talk about budgets in terms of budgeting to the bottom line. So in my integrators, I have 30,000. And in my consultants, I have 50,000. Well, I don't know if I'm going to spend actually 50,000 on consultants or 30,000 on integrators. Suppose nothing goes wrong with my system all year. It works like a charm. Nothing breaks. I've got 30,000 extra here. I can then take that 30,000 and maybe put it toward vehicles, right? And tell the guard company, instead of giving me that old Kia, why don't you upgrade and give me another vehicle and charge me a little more for it, perhaps. If I spend too much on consultants, maybe I don't spend as much on integrators. Usually it's the other way around. Integrators come when something breaks. But if I don't spend this $50,000 on consultants, I just don't need that many investigators. I haven't had that many causes to call an investigator or trainers or anything that I would spend that $50,000 on. But I have more things breaking than I thought, and actually I ended up spending $35,000. I can just take some money out of here. This bottom line number is where you're going to be judged. So you don't have to get all your line items right. So if you take the lesson from that, the more line items you have, right, the more you're able to justify what you need, the bigger this number will be, or the more flexibility you have. If I only had 2 line items here, I better get one and both of them right. Whereas here I have some money, awareness materials, $5,000. Well, if I overspend on integrators, I guess I'm not buying awareness materials. I'm not buying company coffee cups that say security is everybody's business and handing them out to people, right? Not going to do it. I'm not going to redesign my department website like I planned on it. They're going to go with the old website because I needed the money, but I have it. Managing to the bottom line. That's the number you would manage to. Now, you also have to plan future capital. So I'm going to be adding they're going to be adding some buildings to my property, and I need to add cameras, access control, alarm systems, and it's going to be $100,000. The guardhouse actually needs to be renovated. It's old. I had one. Frankly, some of these things are built they're built almost like a trailer, and I had one that the base rusted out and was starting to fall over. And it was an expensive proposition. It was actually a lot more than that, almost double that. I put in $120,000 to renovate the guardhouse, right? To fix the brick that's falling out and the rusted metal around it and make it look presentable. I want to buy a watch tour system. The guards walk around with that little device and they touch it to a sensor and it shows that they were there at a certain time. And I show that to my insurance carrier to show that the guards were doing a fire watch tour, right? I need to add a watch tour system. That's about $8,000 for one of those systems. I'm asking for $228,000 in capital in the next year. If I get all of that approved and they tell me it's a 10-year depreciation, essentially on everything, which is pretty simplistic, but let's say they do, then next year I will have $22,800 added to my depreciation line. And over the next 10 years, that will be paid off. But I get these things right away. So I hope this shows just a little bit about line item budgeting, right? We based all of these on what we did last year, so we did a cost basis, right? We didn't start at zero with anything. We kind of knew what we spent last year, and that's how we built this. By the way, your depreciation number, you're not expected to remember that. Your finance person at the beginning of every budget year will tell you this is how much depreciation you have to account for in your budget. So one of the killers is when people overcapitalize and they buy a whole bunch of stuff, then they find out that this depreciation number, grows and grows and grows and grows, and they can't afford all the stuff they need operationally. Don't let that number get out of hand, right? But remember these things. Line item budgets, you are budgeting to the bottom line. That is what you can spend, is your bottom line. These are just your estimates and how you built that number. A contingency is something you should always put into your budget. It's for incidentals. You should put it in. Somebody else may take it out, but always put it into your line item contingency. If somebody says that's acceptable, you've got this extra money to spend in case something goes wrong. It's your rainy day fund. And if someone tells you when you turn in your budget, you got to chop some money off of it, that's where you can start. And you just have to worry about the rainy days up here and spend wisely. So I hope this kind of shows you what a line item budget looks like. It's not complicated. It is really just building your costs for each individual thing in your department, coming up with a bottom line, and then deciding what capital items you may need and what that might cost. And if your capital gets approved, whatever the capitalization period is, let's say 10 years here, 1/10 of this number will be added up here every year over the next 10 years. Till it's paid off, then it goes away. And even though the company bought you all these things up front, you are able to take them out of your budget a little at a time. Okay, so if you're jumping right to this next slide, shut it off, take 5 minutes, shake the cobwebs out of your head. We went over a lot of stuff and a lot of definitions. I do not expect you to memorize those things. There will be a quiz this week, and I will ask you about some of them, but I really just want for you to understand that the first time you hear these terms should not be on your first job. And many of your competitors, right, for those jobs, will not have had that exposure. Someone will tell them, okay, I need you to help me with a line item budget for next year. And they will have no idea. They might as well speak in Martian, right? They don't understand what's being said. You just need some familiarity to say line item budget. What was that again? Oh yeah, that's where we just lay out everything that we're going to spend line by line, and then we add it all together, and then we know what our number is that we have to spend at the end of the year. If they say, look, I need some, we're being asked for our capital budget for next year, which sometimes is asked for at a different time. What items might you need? All you need to know is that capital items are big stuff that you can't afford out of your operational budget every year. You couldn't pay for these big things. And they are items that are going to last the business, right? They have a lifespan. And all you need to know is that that's that. And then you can say, well, gosh, I think we need, the camera system is old. I think we need to replace it. That can be a capital item. So you just need to understand the difference between operational and capital, what a line item budget kind of is. That zero-based is when you're starting with all zeros and you're justifying absolutely every dollar, and cost-based is when you're taking last year's history and tweaking it a little bit, which is the majority of the time what you're going to do. And the first time you do one, you better do it that way because you're going to miss something because somebody has a history. You just need to check their numbers. That's really all you need to know about the budgeting process. The rest of it will be local stuff when you get to that first job. But if you can understand those basic concepts when you walk into that first job, or maybe even in the interview when somebody says, do you have any experience in budgeting? You can say, no, I do not. However, I understand the basics of a line item budget and what capital and operational expenses are and what they are not. So I think I can learn it pretty quickly. That's the right answer in an interview, by the way, for that question. It gets you a check mark in the box. And that's all I want to be able to say that you can know comfortably when you leave here. So let's jump now to ESRM and some of the tie-ins with finance. So SOX, Sarbanes-Oxley is referred to as SOX in the industry. ESRM talks about risks, right? Finance has a risk that somebody may not do the books correctly, might not keep the right records, or if they do, they might falsify them, right? That is a concern, right? You've heard the term 2 sets of books. Someone keeps one set of books for what they actually did and one for what the law says they're allowed to do, so they can keep it straight. And someday, normally when people do that, they have the idea that someday they'll reconcile the whole thing and everything will be fine. It's not. But there's a risk of SOX violations in finance. Personnel surety, right? I will tell you that, and I don't want to go too long in this lecture because we're getting up there in time, but we hired a person to be a SAP guru. SAP is a system used to order things and pay bills, essentially. It's a pretty complex system. Some of you may have used it in your jobs and didn't even know it. SAP is the name of the company that puts this software out. It's used for keeping track of your inventory, buying stuff, selling stuff. I mean, it's really one big system. Cybersecurity people will become familiar with SAP at some point. We hired someone to be a SAP guru at our payment center under contract. And she came in and they hired her because they liked her. And she had full access to pay the bills. And when we checked her history, after she was under investigation, we checked her internet history. The first thing she did when she got on the job was used her laptop that we provided to her to put in a search, what is SAP? And once she found out what SAP was, she knew it was a finance job, and she just wowed him in the interview somehow. Once she found out how SAP worked, she basically went in and on payments we were making to vendors, she just changed the bank routing and routed those payments to her own bank account. Stuck around for about a month until people started to call and say, why aren't we being paid? And then didn't show up to work one day. And she got us for about $110,000 in that month, just on really small accounts. She could have got us for a whole lot more, but it would have caused a lot more suspicion. So she was smart about it. But personnel surety, come to find out she'd done this before. She had been hired in companies and she embezzled before. And so personnel surety is definitely a risk for the finance department because a person could do damage quickly. Access to data. And in the terms of a physical security manager, access to data through access to facilities. You don't want just anybody looking over your financial records, right? You're required through SOX and other ways to report certain things to investors and to the financial community. But you may be having a bad quarter And it's not time to report that yet, but sales are way down, and the finance department has that because they're doing the receivables and they're showing that money's just not coming in. You're not yet required to show that because it's not time to do your reporting, but if somebody breaks in and sees that, they may come in and short your stock or put the word out, and next thing you know, your stock is tanking because information that wasn't required to be reported just yet got reported early. Access to data is hugely important because a lot of financial data is relatively confidential, and in fact, it needs to be confidential until it's time to report it. So access to data both in the physical access, because a lot of this stuff gets printed out. Finance still does a lot of stuff on paper. They look at things on paper. They print the reports on paper to give to other people because they want to make notes on it. It's just old school way, and finance is pretty old school when it comes to that. So access is a big thing. It's a risk. Petty cash storage. Most small businesses, and even some large ones, have petty cash. It's usually not a lot of money, but I will tell you that when someone has petty cash, there's always a problem with it. Somebody took money and they went into petty cash, and there's supposed to be $1,000 in here, and there's only 900, and nobody accounted for 100, and too many people had access to it. Another access problem. But that is a risk, only because it takes time to investigate. It's usually a small amount of money, but it takes an amazing amount of time to investigate, and sometimes somebody gets fired. Now you've got to hire somebody and train them again. That becomes a much larger loss than the $100. And then check fraud. Check fraud is a pretty big thing. People print checks. They wash checks, if you will. They will print a check with your name on it. Think about checks, in terms of if you had a checking account or your parents had a checking account, it just had their name and address on it, a bank routing number on the bottom, and lines on it. Anybody could reprint those checks. I can order checks, and I don't need to show that. I can go online right now, put in if I have a check that you wrote to me, I can put in your numbers, your bank number, your bank account number. It's on the bottom of your check, your name and address, or mine, right? And have them printed, and then I can start writing checks, and they're going to go against your account the first time. And then you're going to notice it, and you're going to call the bank and say, I didn't write these checks, and then the bank will investigate, and sure enough, there's a problem. With companies, it happens all the time. I chased my tail for years until it was now somebody else's responsibility because people would be cashing Pfizer paychecks that they didn't work for Pfizer. They just printed out checks with our logo on them, made them look like payroll checks. Printers are really good these days, and went and cashed that payroll check. Now, they go to jail. Okay, so don't do that, right? Even in a panic, don't do something stupid like that because it is really a pretty easy thing to investigate. And most places that will cash a check have cameras, and they're able to chase back, where the money went. But there's something called positive pay that most companies use now, where if we process a check through our accounts payable to Brian for $1,000, and it's done on a certain date, all of that information goes to the bank. All of it, who it's going to, what day it was written, what check number we wrote it on, all goes to the bank. And when the person presents the check at the bank runs it through positive pay, and all of those things must match. So if we have a check number and it comes back, it was written to somebody else because somebody printed their own checks and wrote the check out to themselves normally so they can get the cash, a bank will say, no, this is rejected because it doesn't match positive pay. It doesn't match all the elements. It's almost like the bank has a picture of the check before anybody goes to cash it, rather than just have the check come in, cash the check, send it in, and find out it's fraudulent. So there are ways around that. But there are a lot of security risks to a finance department, and that's where you as the SME can come in to help. So what can security and finance do together? And maybe even bring HR into the conversation. Now we're talking real enterprise security risk management. We're looking at real risks, this time to the finance department. Background checks. I could have kept that person out of my accounts payable, one who just asked what is SAP on their first day of work, right? They asked the internet, and then got us for a $100,000 loss if a proper background check was done by the contract house that we contracted with. And in fact, they told us they had, and they had not. But if it was done, she would have never got there. So background checks could have mitigated that risk, right? Understanding who has access to financial records and funds, right? The petty cash fund, the access records, both computer, so the cybersecurity guys in the course, think about that. I mean, who has access is huge. It's not just that you have protections from the outside, but who has access and do they need it is a huge issue for protection of electronic records and paper records, which finance is famous for in most organizations. My peers I've talked to say, yeah, finance is the biggest generator of paper because they still like to do things and put them on paper and spread them on their desks and look at them, right? Understanding what's being purchased, because remember the purchasing stuff and where it goes will help you stem fraud. I had a guy who was purchasing things like night vision goggles. And in the scientific world, in research and development, those actually had a use, right? They were using them for some kind of chemical reaction that they could watch it if they had night vision goggles. It had to be done in the dark. It was just kind of a weird thing. But this guy bought like 30 pairs of them inside of a year, and come to find out that he was part of a militia group, and he was buying them for his friends in the Jeeps that, took their shotguns out and thought they were going to declare war. So understanding what's being purchased is a good way for the security manager to work with finance to stem fraud. Okay, so think about some of these. Do they match any of the ones we talked about before? I think they do, because we talked about HR. We've got some matches here. So let's try one of those things and put it into ESRM terms. Background checks, personal surety, understanding who's who, right? Human resources does the checks at hire, right? To make sure they're not bringing in somebody. Or in some cases, a contract house will do it on your behalf. You got to make sure it's done. Security helps with verification, which was a step that was missed, frankly, in the hiring of the person who ripped us off under SAP, because the background checks had not been verified. That particular step was not in the process. Security wasn't the one who verified it. They do now. It was supposed to be procurement, and they did not. So human resources does the checks. Security helps with verification and gets assurance that they're not granting access to facilities to bad people, right? You're working together. And finance is obviously a clear winner in this, because they need that clear employee background check to prevent fraud and identity theft, right? Reject people with bad histories of financial crimes. So now we have patched up a huge risk for finance using our partnership with HR and finance, and security is part of that enterprise security risk management. We've really looked at something that affects the business. We're not just throwing up guardhouses and cameras and those things. We're actually trying to solve the problem. That's what ESRM is all about. So now you're going to add finance to your list of entities to discuss risk with, right? We have finance at the table now. We're talking about what keeps us awake at night, right? Finance department's going to define their risks. Then you're going to see if those risks or potential mitigations, the things you could solve them with, match those that others have, like HR. You're a subject matter expert. You're putting all of those risks together and saying, okay, how do we solve this with the least amount of mitigations, right? You're going to rank the risks, right? The petty cash one is a risk. It's not as big as perhaps the access risk of people having access to data. It may be smaller, so you're going to rank them. So then you're going to work on the most important ones first. Then you're going to close the gaps that affect the enterprise. That's the whole purpose here. Close those gaps, close those security risks, right? Make them less for things that really affect people in the enterprise and departments in the enterprise. And that's what you've done here when you combine the HR stuff and the finance stuff and the security stuff. If it's any consolation, I know I went over by about 8 minutes on my promise of 45 minutes, but I'm tired of hearing my own voice too. So if it's any consolation, you're not alone. There's some reading this week. The lecture you just completed, thank you very much. There is a quiz. The quiz is due at the end of the week. It's due on Sunday night. It's multiple choice, true and false. No two of you will get the exact same quiz because I have it set up that way, as we said. I would suggest, however, that you take these written notes, and hopefully you listened in the beginning. Otherwise, you're going to be doing a lot of flipping back and forth, and you're going to get some questions wrong. It's a shame that happens. If you put your notes, took good notes on the slides, the quiz should be pretty basic for you. So that's it for this week. Don't get hung up on finance. Don't let your head swim saying, oh my gosh, I've got to know all these financial terms. This was an overview. You've heard the terms. You'll hear them again. We're going to talk about them a little bit in other units, simply because I want you to understand the terms a little bit and be very comfortable with them. When you get to that first big person job, I want you to be as comfortable as possible when you walk in the door. With that, have a great week, and I will see you in the classroom.